following is a paid advertisement program provided by Premier Investments and Wealth Management. An airing of the program is not to be considered an endorsement or recommendation. The opinions expressed are those of the hosts, guests, and callers and not necessarily of KFXR or iHeartMedia.
The information in the following program should not be construed as an offer to sell and is not intended to replace the advice of a qualified tax advisor or legal counsel. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC.
Hey there, welcome back to another edition of the Premier Investments and Wealth Management Financial Program. My name is Doug Wagner. I'm your host, and I'll introduce the three gentlemen with me here at the table in a matter of seconds. But first, I want to remind you that you should, if you're wondering about whether you're ready for retirement, you're not alone. More than half of Americans don't know if they're ready for retirement. You could be part of the better half of that. Go to premieriwm.com. You can use your phone. You can use a laptop. You could use a tablet. You can even sit there at your desktop. premieriwm.com. Click Get Started. Answer a few questions, and they'll provide for you a one-page Premier Vision document that really will help serve as your financial roadmap for the future. Are you ready for retirement? Maybe your kid's education. Maybe you've got the dream of purchasing a lake house or a little hunting cabin up in the Texas Hill Country or southern Iowa to go pheasant or deer hunting. Any way you look at it, you need professional help in order to get to these places in your life you want to be. premieriwm.com is the place to go for Premier Investments and Wealth Management, named to Forbes 2025 Best in State Wealth Management Teams. Or you could call 800-383-6590. Sitting to my right, new sheriff in town. He's a vice president of the firm, Wealth Advisor Well. Hey, Elias, how are you doing? Elias Randall.
Doug, hello.
Good to see you. Almost football season.
It is almost football
Ready?
season. Yep. Yeah, I stay ready.
Let's do this. I'm serious. I'm excited about this. These final days of summer, we're getting into fall. I'm excited. Jonas Everett is a wealth advisor
with over 30 years. He almost threw his flag out. I almost dropped my water there. Elias almost threw his flag, called a penalty on me.
Jonas has got over 30 years of experience in the investment industry. Jonas, are you ready for football season too?
I'm all set.
Okay.
I'm not quite sure what I'm more excited about, college or pro, but I'll decide.
I know. I'm trying to figure that one. We'll get there, though. We will get there. President and Wealth Advisor, Premier Investments and Wealth Management. He's an accredited investment fiduciary. He's got over 22 years of experience in the investment industry. You know him as Roger Abel. We know him as the Big Kahuna, the head coach with the most. He's got it going.
There's another
flag.
Roger, how you doing?
I'm good. I'm just getting ready to work on my head coaching skills.
There you go.
Also known as fantasy football.
Yeah, exactly.
I started watching fantasy football
videos
really? About a week ago.
Okay.
Yeah.
Getting ready to go.
NFL preseason. Didn't that kick off the 31st of July or something, did I see?
Yeah, it's crazy.
Yeah,
so
I'm
it's
ready.
like you've got Hall of Fame games and you've got all these other games that, head into there. So it's going to be an interesting football season, to
I
say the
love
least.
Fall.
Yeah, I know.
Definitely my favorite holiday.
Exactly.
And fall is a holiday.
What's that?
Fall is
a
holiday.
holiday. It's one.
Yeah, fall is a holiday.
Premier Investments and Wealth Management. Hey, there's a couple of other things over there. They've got a financial wellness quiz over at premieriwm.com. Find out if you're on track for retirement by taking that as well. We have listener questions today, and I love listener questions, and I know you all love the listener questions too. So I'm going to start out, since I haven't seen you in so long, Elias. I'm going to give you the first question. Ready?
Yeah, I'm ready. Let's hear it.
John asks, I'm 58 and I just got laid off after 25 years with the same company. No pension, just my 401k and a small emergency fund. I've always assumed I'd work until 65 or 67. I want to make a smart decision, but I'm overwhelmed and I'm just not sure where to start. How do I figure out if I can retire early or if I need to get another job? What would you say to John?
Step one, you call Premier and come meet with us.
There you go. 800-383-6590.
That's a wrap.
Yep.
Show's over. That's all you need to know.
So I think a couple things come to mind. And I think, one, you don't want to rush into any decisions.
Mm-hmm.
You want to make a good decision. And I think this is we talk about in our business all the time, how people have life events, and then that's really motivating factor for them to come in and have a meeting and get some of these questions answered. And this is a pretty common one.
Yeah.
Being laid off closer to retirement and if you're John, and what if you're financially independent right now and he doesn't know it?
Yeah,
Well, if he is, does he want to go back to work?
exactly.
Do you even want to go look for another job? So I think one, don't panic. This will give you some time to make a good decision. And, if you want to start getting stuff together, take an inventory of what you have. That's another good step too, because any firm you go to, they're going to want you to disclose all of your statements and documents and the things that you have.
Right.
So really, first things first, are you already financially independent? And if you are, then you have more flexibility. If you are not to that point yet, then you might want to start looking for a job.
Yeah, it's interesting, Jonas, because he talks about having just a 401k and a small emergency fund. And so maybe he doesn't have the other things that you work with clients on a regular basis, IRA, Roth IRA, as well as sort of a cash investment account as well.
This exact same thing happened to a friend of mine at League. He came up to me and he was laid off from the gas company, and I like what Elias said there. That I know that there's a lot of emotions involved, but if you take an inventory, and I know my friend has done a good job saving money. And I tried to make light of it with him. I actually bought a inflatable axe, and I went the last league. I was like, hey, you just got axed, and now you're getting axed again.
Shut him out. Wait
trying to make light of
league?
it.
What league is this?
Bocce ball league.
So you have an inflatable axe.
I have an inflatable
and you have
axe.
soft bricks.
Soft bricks.
Soft bricks.
I
Yeah,
probably
all the
supplied
props.
those for you.
But
Run a movie theater here.
almost,
Jeez.
so many props. Where's the rubber chicken, right? So half of Americans are going to retire unexpectedly.
Right.
And there's only three ways to look at it. There's three off ramps or on ramps, however you want to look at it. You're going to retire early, you're going to retire on time, or you're going to retire later than you expected.
Yeah.
And if you have that mindset going as you're nearing retirement, but I think the best thing to do is to plan and look at not working full time as a milestone, not as something horrible, especially if you get laid off. It's still a milestone, but if you plan for that, it's going to make it a lot easier for you.
It's interesting because go ahead. Sorry. Brian.
Well, you hit on a good point, and people's expectations of how long they're going to actually work don't align with when they actually retire. And here's how I know this. I teach a class for a couple local hospitals, and one of the statistics in there is that 30% of the population believes they will work until they're 70 or they will work forever. The reality is only 6% of the people make it to 70 working. So what that really tells me is that, number one, people retire earlier than they're planning on, whether it's a layoff or they got a financial plan. They realize they no longer have to work. You should plan on, in my opinion, retiring sooner than you think you're going to. Because the reality is, that's what's going to happen.
Exactly where I was going to go.
If you work 5 years longer, okay, then it's all gravy. But if you plan to retire at 62, but you work till you're 65, we're all just better off.
Yeah. No, it makes sense. We're talking about John's question. He's 58. He just got laid off after 25 years with the same company without a pension, just 401k, and a small emergency fund. He said, you know what, maybe I've always thought about working until 65 and 67. He feels kind of overwhelmed right now, and he wants to figure out if he can retire early or if he needs to get another job. The big thing when you do a financial plan at Premier Investments in Wealth Management, they talk about all the different things that are potential incomes. Jonas hit upon a little bit earlier. Talk about all the things like the potential for gig economy, the potential for part-time jobs, even Social Security, and how the timing for that and your income needs might work.
Well, it depends on, apparently he's 58, so he's got a little challenge, right? You don't have a ton of liquidity in your 401k yet. There are ways to access that. If John has done a great job saving, and he's done a financial plan and shows he doesn't have to work, he doesn't need to take Social Security, there are ways to get into that 401k without a penalty. And a lot of people don't know that, which a little bit it goes to my thesis of, I think, why people end up retiring sooner then they plan on retiring, they realize there's ways to get into these investments without having a penalty. Most people, if you say, when are you going to retire, the earliest they'd ever say is 60.
Yeah.
Because that's when they believe they can get in their investments without a penalty. But once you figure out, okay, I've done a plan, I don't have enough to sustain myself just in this 401k. I'm going to have to work 4 years. There are options, right? You could find something you love doing. You could do a gig economy. I've seen people who this has happened to, they make more money after they got laid off than they did before. They become a consultant and they don't realize what the opportunities are outside of employment by a traditional employer.
Yeah, and that makes sense. Wanted to talk to you a little bit, Elias, about the idea of, we said many people, they think, oh, I'm going to work till 65, 67, I'm going to work till 70. They end up retiring early. And for a lot of those people, the reason that happens is because of healthcare issues. Talk to me about healthcare and retirement for somebody like John, who's 58, thinking he's going to work another 7 to 10 years.
Well, healthcare, it's a wild card for people, and it can be expensive. And it is a cost that you're going to want to pay because you do need some sort of care. So whether it's your COBRA options through work, getting an Affordable Care Act plan in the marketplace, if you have a working spouse, maybe you can get covered on that plan. I think the best route to go is to just look at the different options you have available, get educated on what's going to be what, and then you can make a good decision because you'll be 65 when you can enroll in Medicare.
Okay, so 65 is when Medicare availability begins.
Yes,
okay.
yeah.
Gotcha.
So you'll be 65 when you can enroll in that. So you're going to, for most people, you're going to have to do something until that age.
Okay.
And you can get enrolled in that
I
program.
got a question. So we do a lot of financial plans. How many of your customers at 58 know how much health insurance is going to cost?
When they're 50, none.
None. Guess what does? The financial planning software can help them estimate the cost. Drag healthcare in, it takes the average ACA based upon where they live, what state they live in, and then how much they're making, and determines how much it's going to cost them out of pocket. So a lot of people, the missing puzzle of early retirement is, can I afford the health insurance?
Yeah.
We can say, well, if an individual needs $5,000 a month for their bills, I bring in the health insurance, the software will estimate it for us. We can bring a lot of confidence to people that don't know what they're going to do with health insurance. Yeah, I've been doing this since 2002. And I remember, and you remember this too, I'm sure, because back in 2002, we still did health insurance. We were just getting started, so we'd sell health insurance to people. And in 2002, the first thing I would ask somebody about if they wanted health insurance, what's your health? Like, can you get it? That was the first thing I'd ask somebody. Today, I don't ask what's your health. I ask, how much can you afford to pay? Because for an individual who's 58, it's likely close to $800 or $900 a month.
Yeah.
So the question now is, can you afford it? So it's really transitioned the health insurance conversation over 20 years from, are you healthy, to can you afford it?
We back in 2002, Doug, we were looking to see if they had the pocket for cigarettes first before we asked them anything about their health.
Yeah. Are you smoker or not smoker?
Yeah.
And exactly. I real quick, I understand how John is very bummed out here. And my biggest, I guess the biggest rock in my shoe that I have is his small emergency fund. If he were to come in and do a plan, we would address that
Jonas loves
right away
emergency
because, even before exploring some of these health insurance premiums that he's going to have, he's going to have to make some serious adjustments and get an emergency fund that is going to at least take him, bridge the gap between 58 and when he decides to draw Social Security.
But the emergency fund could be the 401k.
Right.
That's the missing puzzle. We don't know how much he has in this. He might have $3 million and totally be able to set
He says a small emergency fund. It could be like 50,000. You just don't know it. For
small
him,
is
it might
relative,
be small.
right? If you have $3 million, you might have 150,000 as your emergency. You don't know.
Exactly. Premier Investments in Wealth Management at premieriwm.com. Go to the website, check it out, and while you're there, click on Get Started, answer a few questions. They'll provide for you a one-page Premier Vision document and an opportunity to sit down with a professional wealth advisor like Elias, like Jonas, like Roger, any one of the staff. They're going to be able to sit down with you and talk with you about what your needs are. I really love what Roger talked about, is that you don't know how much health insurance costs, but you know what? The financial software that they use does. And that's part of what you go to a professional for. I mean, you just don't go to somebody who lays their hand on you and said, ooh, I think you got X condition. They don't do that. You don't do that with, does your doctor do that? No? Okay, good.
No.
I'm glad to hear that. But the whole point is you go to a professional for a reason, and that's why Premier Investments in Wealth Management is there for you. They were named Forbes 2025 Best in State Wealth Management Teams. Go to premieriwm.com or call today for your appointment, 800-383-6590. Finishing up with John's question here. One thing for me that I noted right away is that he does a lot of talking. He doesn't mention a spouse, a significant other, anything like that. And for me, it's one of those where he could have a silent partner that's out there that we don't even know anything about at this point, who maybe has not been involved with his investing. When you bring in people, you say, hey, if you're a couple, we need to see both of you because you both play a part in this.
Well, we hope so if they're both going to be involved, right? Mm-hmm. And that is true. We don't know that from this question. But I think here's what I think the next steps are for John. Mm-hmm. You're going to want to build out a retirement readiness plan. And then also just consider, like, what is your plan B going to be? Do you maybe need to work part-time to have some extra income? And I know some retired, I was just talking to a friend of mine who's retired the other day, and he's a golfer. So in his retirement, he mows at the golf course and plays golf. And to me, that sounds pretty fun. Mm-hmm. That kind of sounds like a fun way to be retired.
Yeah.
So I think there's plenty of options out there. It's just going to take, some planning and putting some thoughts together. It's really just never like a yes or no answer. Mm-hmm. There's a lot of moving parts involved.
Yeah. We talked about making sure you do things that make decisions with less emotion and more forethought and thinking ahead of time, Jonas, making sure that you get out in front of it. Just take your time.
Yeah, if one of the real disasters, financial disasters that we see people is they make bad emotional decisions. They get laid off. They start taking lump sums out of their 401ks. Mm-hmm. I had a family friend that started to do this. We talked about this, Roger, on another podcast, that if you start, no matter what the balance is, you start clipping away $35,000, and you got to pay taxes on it, $20,000 the next time, $50,000 the next time. You're killing your golden goose. Mm-hmm. You're not going to get any more golden eggs. So, if I were John, I'd be very cautious about making any emotional decisions. It's all mathematical. Come in, do a financial plan, see how the math pencils out.
Makes complete sense. Premier Investments in Wealth Management, 800-383-6590, or make your appointment online at premieriwm.com. Listener questions this week. We're talking with Brody, who asks, I recently inherited $100,000 from my grandmother. She worked hard her whole life, lived simply, and saved carefully. It means a lot to me to do something smart with this money. The problem is I'm nervous about investing it right now. Keep hearing that the stock market's at an all-time high. It feels like I'd be buying at the top. Part of me wants to wait for a dip, but I'm also afraid of missing out if the market keeps climbing. Roger Abel, what's the right move?
The market's going to continue to keep climbing. I think this is an ironic question that came in based upon the episode 2 episodes prior to this, as well as a podcast we just did where we actually talk about understanding that the market hits an all-time high on average every 19 days. And an all-time market high is not a flaw of the stock market. It's a feature. That's good. And really, I think the first thing to understand is you're not alone. Lots of people feel this way.
Okay.
But and people want to buy low. And we have to almost quantify low. Is it a lower price than it is today, or is it a relatively low price to where the price is when you want to buy? And I think one of the things that you need to think about is typically the best time to buy was yesterday. Jonas, I think right after our last episode, you came out and we were talking about this chart and shows and compares, maybe Molly can post this, investors who buy on the all-time high versus the dip buyers since 1989.
In 1, 3, and 5 year increments.
1, 3, and 5. Outperformed by almost 20% when you buy at an all-time high versus trying to buy a dip. Okay, because what happens? The market is $100 today and it goes to 110, and you're like, well, I'm going to buy a dip. Well, then it goes to 115.
Yeah.
And then it dips to 111 and you bought your dip at 111, which you could have just bought it at 110. So I think you could go download the guide. We wrote a guide on this. It's at premieriwm.com, and it's how to invest at stock market highs. And I think it's really good education. And I'll be honest, until we did the research on this, if you would have told me that you're better off buying on an all-time high versus waiting for a dip, I would tell you I didn't think the math would pencil out.
Seems counterintuitive.
Counterintuitive.
Yeah.
It's counterintuitive because what have you been told your whole life? Buy low, sell high. Well, at the end of the day, low is a relative value.
Right.
I think the beauty here is, Brody, don't be fearful of this. Most people are. But go get your financial plan in place. Figure out what this $100,000 means to you in your financial picture.
Yeah.
It could be you don't have an emergency fund. So maybe, as Jonas would tell you, you need to go take, 20, 30, 40,000 this for an emergency fund and invest the rest. I feel like a lot of people who are nervous about investing a big chunk of money likely have never had this amount of money before. I'm gathering, I don't see how old Brody is, but I'm gathering Brody's not that old.
No.
That's what I take from this. So if you're 23 and you ran into 100,000, you haven't been through any market cycles yet, you would probably be fearful. But I think the best thing you can do is go get some financial coaching on, hey, how does this make sense in my overall long-term picture?
And the nice thing about this, Jonas, is he seems very based in this whole thing because he said, hey, my grandma lived simply, worked hard, and I want to do something smart with this money. So again, you'd be, let's get a spare tire and another spare tire going. But the other thing too is that take a look at this, because if you've got a long-term investment horizon, you're always buying low, no matter when you're buying.
Yeah, we talked about this. Inheritances versus a 401k, there's more heartstrings attached to inheritances. It's tougher for people to invest. But if Brody has 100,000 in his 401k, he's probably in the market. But this is the same amount of money. This is $100,000 inheritance, and it really depends on his age. But yeah, if he has a 15-year time horizon, and then really, I like the idea, guys, that if you are nervous, who's to stop you from just putting some money in each month? And if you have some long-term, if Brody decides that a part of this 100,000 is going to be his retirement, and this is how I would help him. You tell me, I'd give him a piece of paper, write down how much of this 100,000 we need to do. I love my spare tires, Doug. So that's got to be first.
Tires.
The emergency fund's got to be first. But how much of that 100,000 would you like to put away for your retirement? He writes his number down, and then we can start there. And if he's nervous about the market, the market is not going anywhere. It's never going to go anywhere. We can actually put money in each month, and if that makes him feel better about it, even though Roger has the data that says that he might miss out on some returns, if he's more comfortable with that, that's the name of the game with the financial plan too. It's got to be comfortable. It's got to be a level of comfort for the customer and the advisor.
Right. And Elias Randall, we're talking about, a younger guy, maybe 20s, 30s, say maybe 35, up to 40, the max at this point, or something like that. It feels like the idea that he's got so many opportunities out there in order to put things together. I mean, what's the money meant for? I mean, Jonas said, okay, we'll write that out. And also, you've got so many different instruments that are out there. You've got stocks, you've got bonds, you've got mutual funds, you've got IRAs, you've got Roth IRAs. There's a lot of things that can figure into this mix that can get kind of confusing really quickly.
There are. And the basic question in investing is, what are your goals for the money and what is your time horizon? That's about as simple as you can get when you're making decisions. And I think in this case, especially if you're a younger investor, I do like Jonas's idea of dollar cost averaging, right? Here's the amount I'm going to do every month. Because really what you're doing is you're saying this is going to be my strategy and then I'm going to stick with it, right? So if you're going to do something like that, you need to come up with the strategy and stick with it. And a couple other things I'll point out here from the notes, and Roger was getting to some of this with the data he was sharing. So all-time highs are very normal in the market. The market spends a lot of time trading near all-time highs. And the other day I heard someone say it's a persistent number. So the new, and it happens every 19 days?
Every 19 days.
Right. So every 19 days, we're getting a new all-time high. So that's much more persistent. And these companies, at the end of the day, they continue to grow their revenue. So their stock price should go higher. But those numbers persist throughout time.
Right.
The market going down and staying down has never persisted throughout time. So I think time is on your side. And it's easy to get scared when the market's high. And we talk about that all the time too, is, well, okay, it's hard to get in right now, right? Hard to get in.
It's time to buy.
When it's hard to get in, that's time to buy because it's hard for everyone. And the market being high isn't signaling, right? It's signaling growth in the stock market and the economy. It's not necessarily signaling that there must be a correction because the price is high today.
Right. It's interesting that when we were talking about this, because there's so much that goes into this. If you're an individual, you may say that's way too much for me to wrap my head around. That's why the professionals at Premier Investments and Wealth Management are here for you at premieriwm.com. Take the financial wellness quiz, click Get Started, and answer a few questions. They'll provide for you a one-page Premier Vision document and a free appointment to go over it with them, and they'll hand the one-page document to you so you can walk out the door with it. Make your decision. Am I going to invest here? Am I going to be with them? You know what? I'm going to think you're going to be with Premier Investments in Wealth Management because they're talking about your financial future in terms that you are as well. I think that they have a really good understanding. Fabulous staff, both front office and then the back office staff as well, that handle what you need, because there's a lot of complications or potential complications that you can avoid by having a professional handling these things for you. With your goals in mind and how you want to get there, Premier Investments in Wealth Management. They were named to Forbes 2025 Best in State Wealth Management Teams. Go to premieriwm.com or call 800-383-6590. I'm going to wrap with this, and then we'll move on to Andrea for the final segment of the show, the last 15, 20 minutes. But is something for me when we were in the end of our last program, it's something that when you were talking, Roger, it popped into my head. Don't let the perfect get in the way of the possible. If you sit there and wait for the perfect time to do something, you're going to get called out on strikes.
Well, here's the question to ask yourself. In 20 years, will my future self be happy with my decision?
Yeah.
And if you went back 20 years from today, how much of the stock market would you like to have bought? How much would you like to invest in the stock market 20 years ago?
Right. Most people are going to say
everything
of my
I
discretionary
had.
income.
Go find me a 20-year period of time where someone could look back from today to 20 years in the past. How much would you have liked to? You brought up Jonas 2000. We were talking about those numbers where, basically all-time high investors had outperformed dip buyers. And you brought up 2000. I said, okay, well, maybe there was a 5-year period of time it didn't work out, but you still would have tripled your money. So it would have been okay. Because if you bought in 2000 and did nothing, you still tripled your money and did better. So at the end of the day, just ask yourself, in 20 years, will I be happy with my decision?
Yeah.
And if you look at every 20 years previous, you're going to be like, man, I wish I would have bought as much as I possibly could have. So unless you're over 50, I'm going to guess you have at least a 20-year time horizon, because time horizon is not when you retire.
Right.
It's when you die. So we have longer time horizons than most people actually believe.
Mm-hmm. Well, the other thing is that the whole point is that you need a plan. And that's the whole thing, is that just sitting there and saying, if you say I'm going to do this or I'm going to do that, it's not a plan, because, again, you need to look at, what do I want my retirement to look like? And that's the question that you ask right off the bat.
Elias made a comment,
Mm-hmm.
like, you have to give this money responsibility.
Mm-hmm.
What's the goal for the money?
Okay.
The goal might not be retirement.
No.
The goal might be a down payment on a house.
Mm-hmm.
Totally different type of investment if it's a down payment. But when you start to put goals and priorities, it starts to align with how you're going to invest the money.
Mm-hmm.
And a goal for your money is not to make more money.
Right.
That's not a goal.
Well, I
Like, it's just not.
I like how Brody said, he's nervous, and that's what that's the kind of people we work with. We don't want to work with people that are super confident about everything. That's just not human nature. But if I were Brody, I'd do a little bit of my own research. Look at you could take our word for it, but look at the masters out there. Look at the greatest investors of all time. And Peter Lynch ran Fidelity Magellan, like a 10-year track record, probably mutual fund manager. No mutual fund manager is ever going to beat Peter Lynch's 10-year record. He said about lost opportunity, he said more money has been lost trying to time the market than has been lost in the market.
Mm-hmm.
Think about that.
People waiting for the right time.
Yeah, absolutely.
Don't let perfection get in the way of the possible.
Yeah, and I mean, this is a very smart guy.
Mm-hmm. You're all smart guys.
Yeah.
This is the whole thing, is that they want to share this. They've been doing this for years. I mean, Elias, you've been doing this, I don't know how many years. Jonas, between the two of you, you've got over 50 years. You've been doing this almost as long as I've been alive, for goodness sake. So they've got a lot.
Don't make me feel old. Come on, man.
You throw him in there, and it's well over that, too. So Premier Investments in Wealth Management at premieriwm.com, or call 800-383-6590. Let's go to Andrea's question. Jonas, my husband just turned 62. He's ready to file for Social Security. His reasoning? It's guaranteed money, and he says, you never know how long you live, so why wait? I'm 60, still working part-time, and I think we need to hold off a few more years to get the higher benefit. We've saved consistently, have a decent nest egg, and don't need the income right away, but he's worried about, quote, leaving money on the table, end quote, if something happens to him. I'm trying to be strategic, but we're not seeing eye to eye. Who's right? Jonas, you now are not only a wealth advisor, you're now a marriage counselor.
I guess so. And everybody needs a ride home if they rode together to the financial planning appointment. You definitely want to ride home. So
They have Uber now.
Humans make emotional decisions,
Right.
and they back them up with rational decisions.
Okay.
So this is the husband is he's being emotional about something that is rational, and you need to. We talked about this at length. You could do it on your own. There's financial planning softwares that include Social Security planning, or you can come in and talk to a professional. But don't let those emotions, and you need to, like Elias said earlier, take an inventory. If you have a decent nest egg.
Mm-hmm.
Usually, on a whim, the only time I have recommended that somebody take Social Security early is when they don't have a nest egg.
Yeah.
They haven't done they haven't done a good job saving money. So or
if they've got health issues or they've got a family,
absolutely,
because my parents have lived well.
That's
in their
absolutely
80s,
right.
Or they have so much it doesn't matter.
Yeah. So again, the psychology of my uncle took it at 62, or my aunt didn't get it, and you want to come in and do a financial plan, see how the math pencils out. But yeah, you hit the nail on the head, Doug. Life expectancy, and then have you done a good job saving money outside of that guaranteed system? Right. It's a system that's going to pay you for living too long.
They both could be right, Elias, couldn't they? I mean, what happens is that you need to be able to sit down with them to have them walk through the situation. Okay, what happens if you do pass early? She's only working part-time. Is she good? I mean, I don't know what this whole thing means as far as survivors benefits and nest egg and all this stuff.
So there's trade-offs to understand, right? So in this particular case, you have a married couple, and maybe Andrea, the wife in this instance, I want to be strategic. Well, at some point in the future, you're going to lose a Social Security check when one of the spouses passes away, right? Unless you both pass at the same time. So there are trade-offs to waiting, right? So if you wait, you don't get it today, but the benefit does go up, and maybe that helps your long-term income planning with a higher amount. And then what it also helps with for married couples is when one of you passes away, you're going to lose the smaller check.
Right.
So sometimes it does make sense to either let one or both to delay it and continue to go up in value. Now there's also a break even, and that's what everyone wants to know, right? Well, if I wait until 70 or 67, whatever the age is, how long do I have to live until I'm better off for waiting? It's typically 12 or 13 years.
Okay.
Every strategy, there's a different number of years. But I think the more you understand the trade-offs, the different strategies, and make this decision with a little more than, well, I'm going to take it at 62 because
I don't want to leave it on the table.
Right, because I don't want to leave it on the table. And if you have enough money, maybe that is a good enough reason for you, but there's more that goes into it.
So here's my take on this. Everybody wants to maximize Social Security. The only way you're going to maximize this is by luck. You're literally going to have to pick the exact year or age that both you and your spouse die to maximize it, right? That's what's going to happen.
Yeah.
Like, that's the only way to maximize it.
Right.
The second thing is, the husband mentioned he's concerned about leaving money on the table. Well, if you die at 68, you actually won't know that you left any money on the table.
No.
You won't be here. So this is how you make this decision. You run the financial plan. You run it with your husband's bias to taking it early. And then you compare it to waiting. And you see what the probability of success is both ways. If the probability of success is 85%, whether you take it at 62 or 70, what that does is lets you know you have financial planning permission to take it at 62 because there's not a negative impact on your financial outcome.
Right.
But if taking it at 62 has a probability of success of like 60%, and it's 90 if you wait until 70, you answered your own decision.
Yeah.
Like, that's how you do this. But at the end of the day, I feel like as an industry, we always talk about how we're going to maximize all this stuff. This is the one that's almost impossible to maximize because you don't know when you're going to die, and you don't know what order you're going to die. Your husband might die tomorrow. Like, we don't know. So why are we maximizing it? Figure out what works best for your situation. And then if your bias is to taking it early, it doesn't affect your financial outcome long-term, take it early.
It's interesting because I remember a number of episodes back, we talked about the couple that had been retired and they were like, we've been thinking about going on this vacation, but it's just way, way too expensive to do so. And you said, okay, how much is it going to cost? And they said X number of $1,000. And you put that in and you said, okay, what do you think the percentage probability that this financial plan is going to work if you take that money out to do that? And they said, you're still at 99%. You don't know until you do that. And that's the kind of thing that you can do with this professional financial software that you use.
It's not just us. There's software all over that you can do this. But we do a lot of them. We think we're pretty good. Word on the street is we do pretty snazzy financial plans. Okay.
Yes.
Jonah said he heard
You
that.
are correct, sir.
But I think just so many of these questions can be easily answered by walking through a very simple financial planning process, which is realistically 3 to 5 hours of somebody's time.
Right.
That 3 to 5 hours to figure out and give you confidence in how this might work seems like a pretty good investment to me.
Yeah,
it
does.
Really, Andrea's husband is, we deal with this all the time. He's got some FOMO. Fear of missing out, right?
He won't know he missed out.
Yeah.
He won't know.
Yeah, exactly. No, you're right about that. But the whole thing for him is like the fear of missing out is still real. If it's not happening to you, then it's still real when you're there because he's like, I don't want to leave anything unaccompanied. But at the same time, I keep thinking about his wife because if you defer, delay, and you can grow that, what's the percentage growth after X number of years between 62 and
It's 8% a year.
8% a year?
But here's the other thing. This could actually be the husband recognizing his relationship with money and knowing that, hey, I'm not willing mentally to break into my piggy bank.
Mm-hmm.
I would much rather just have the government give it to me out of their piggy bank. And I have clients who they should probably wait. They don't have to wait. It's a choice. But they refuse to spend any money. So guess what I told them to do? Why don't you turn on your Social Security? Because at least you'll enjoy some of your early years in retirement because you're not going to take any money out of your account. Might as well get this money and spend it.
Yep. Spend every last penny.
We do make a lot of
Every month.
concessions, even if the math pencils out, as long as the customer we feel is in a better situation. And a lot of that is emotional too. If they do a financial plan and they feel better about their money, they feel better about their income. The last thing I want to see, though, what Roger mentioned, if you do take it early, I would like to see somebody spend that. I do not want them to turn around and put it in the bank because they are giving up that 8% compounded increase in their paycheck by taking it early versus full retirement age.
Got about 4 minutes left in the program, and so Elias and Jonas and Roger, I'm going to ask Steven's question real quick and let you guys toss us around the table for a little bit. My spouse and I have talked for years about buying a lake house. Nice. Somewhere we can escape on weekends, bring the grandkids someday, maybe even retire eventually. Both in our mid-50s and financially we're doing okay, but every time we start looking seriously, I get this pit in my stomach. I keep thinking, what if this sets our retirement back 5 or 10 years? I don't want to work longer than I have to, and I don't want to regret a big purchase. How do we know if we're making a smart move or just letting emotions drive the decision? Elias? Start with you.
Well, it's perfectly okay to want a lake house and to want to do stuff like this. And I think the thing holding them back is they have no idea if they can truly afford it or not. And so if you're thinking, well, if we do this, we're going to set our retirement back 5 to 10 years. Maybe that's true. Maybe it's not. Let's assume it is true. Maybe it does set you back 5 to 10 years. Then you could ask yourself, am I willing to work longer to accomplish that goal of having the lake house, right? And it's also possible if you've done a really good job saving, like there aren't that many financial purchases. Like if you've done a really good job, there's not that many things that are going to blow up your retirement if you've done a really good job of saving and planning for it.
And you said this on the radio too one time. You said, I always thought in retirement that I'm going to take the whole family and we're going to go camping like those Subaru commercials and turn into like the medieval people or the Celtic people and go. And then I thought to myself, man, I really don't like to go camping. So, skip down to number 3. They could rent these vacations out easily enough. They could rent to the point to where they would know if they would like it full-time or if they would like it part-time. And I'll kick that over to you, Roger, because you actually did something similar to that. You rented vacations until you bought them.
And then we bought one. Yeah. Here's what I think about this. First, we run this scenario a lot in the financial planning software. What is the effect if I lower my savings rate $2,000 a month because I'm going to take a mortgage or finance this lake house purchase? But here's another question to ask yourself. When I retire, will I make this purchase? Seriously, like when you're 65, will you buy a lake house when you're 65? And the answer to most people is going to be no, because you missed out on the grandkids, you missed out on the kids, you missed out on all these other things. And I think the other thing to recognize, buying a lake house is not like buying a car. It's a different type of asset. It's likely not going to go down in value. Now, would it return as much as a stock market investment? Maybe, maybe not. So you're not throwing the money away. In what they could actually do in this situation, they could say, hey, you know what, we're going to buy this lake house. We're going to own this until we're 72 years old, and then we're going to sell it. Mm-hmm. And you can model putting the money right back into the financial plan. And likely it has little to no impact on their long-term retirement plan. But those are some of the creative ideas that we think about. Now, I had somebody ask me about a month ago, you know, what is it that you guys do? And really what we do is we try to find the stuff and see it from a different point of view and find the stuff that's not in clear sight. Mm-hmm. And a solution like that, people believe, well, I bought this place, now it's mine. Yeah. You can sell it. Mm-hmm. We don't have to get attached to these things forever. If you need to sell this when you're 72, go do it. You don't know if you're going to make it to 72.
It could be something else too, where maybe they decide to keep it within the family and they say, this is our family tradition. You're going to bequest this and it's going to live on in perpetuity within their family, you know, up to some point or something like that.
If you went in our area, let's just say a 5-state area around where we are, 20 years ago, you bought lakefront property. I don't care if it's nice or not now. Oh, you did really good.
That you did.
And there's, in certain areas have appreciated much more, but there's areas that are now catching up. And I mean, I'm not saying that you should do it, but I think quantifying what it does to your retirement, the extra spend, and then figuring out if you have to sell this later on. But in my world, if I wanted to have with grandkids, I kind of would want it, have the experience. And if I have to sell when I'm 75, so be it.
You need a partner like Premier Investments and Wealth Management to help you make these decisions about your retirement, about so many things in life. Get in touch with them today online at premieriwm.com. Premier Investments and Wealth Management named to Forbes 2025 Best in State Wealth Management Programs. Or call 800-383-6590 for Elias, for Jonas, for Roger. I'm Doug. We'll talk to you next week.
The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments in Wealth Management and LPL Financial do not provide specific individualized tax or legal advice. We suggest that you discuss your specific situation with a qualified tax or legal advisor. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. Dollar cost averaging involves continuous investment in securities, regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets. Forbes' Best in State Wealth Management Team's ranking was developed by Shook Research and is based on in-person, virtual, and telephone due diligence meetings, and a ranking algorithm that includes a measure of each team's best practices, client retention, industry experience, review of compliance records, firm nominations, and quantitative criteria, including assets under management and revenue generated for their firms. Investment performance is not a criterion because client objectives and risk tolerances vary, and advisors rarely have audited performance reports. Shook's research and rankings provide opinions intended to help investors choose the right financial advisor and team, and are not indicative of future performance or representative of any one client's experience. Past performance is not an indication of future results. Neither Forbes nor Shook Research receive compensation in exchange for placement on the ranking. For more information, please see www.shookresearch.com. Shook is a registered trademark of Shook Research, LLC.